There's no alternative to using the dollar today. But if U.S. debt and our maturity, frankly, in handling it, and our use of this global financial system as a geopolitical mechanism becomes more and more costly for everyone else in the world, then the incentive to develop that more efficient system is higher, right? And so I think the real risk of a sweep is that folks start to get more concerned about the fact that the interest payments on our debt is more than our defense budget. But then if I fast forward that 15, 20, 30 years, we might look back at some of these events of the last couple years and the next couple and say that was the beginning of making it really hard to trust the U.S.
A warm welcome to the On the Tape podcast. I am Guy Adami. I'm always joined by Danny Moses. Danny, how are you?
I'm great, Guy. How are you doing?
I'm well, 3-9 as we reach week 5. You made a statement last week. You said if you went 0-2.
That was it. I'm done.
You said that's it.
Yep. We can talk about that later. But unless you can see the field clearly, and Lauren Goodwin is here.
Well, see, you jumped me a little bit.
I know, but I want Lauren.
She's
looking at me like, what? So when we started this podcast, this is year 4. Year 1, I couldn't lose. I'd pick 2 or 3 games a week. I was like 27-6.
Yeah.
And then last 2 years kind of muddling around 500, but sweep through the playoffs. This year in the NFL, I'm 3-9. And it's just a whack
embarrassing.
Year. So sometimes you got to take a step back, like you do in the market sometime.
Exactly.
Anyway, please continue.
I will. Usually we're joined by Dan Nathan, but Dan is in parts unknown right now. But we are fortunate enough, and you mentioned being able to see the field.
Yeah, or not see the field.
Well, this is a person that can see the field.
Thank
It comes
you.
in the form of Lauren Goodwin, the Chief Market Strategist at New York Life Investments. Lauren, how are you?
I am great. It's only getting better.
It is getting better. Now, can I do a little off the reservation stuff?
Well, when do you not go off?
So I am an odd person. You know this.
Yeah, but that's what makes you so wonderful.
That's what makes me special. And we were at the Milken Conference, Dan Nathan and I, and we were preparing to do CNBC's Fast Money.
In Los Angeles.
In Los Angeles,
Okay.
California.
Yeah.
Which is on at 5 o'clock on the East Coast, which is 2 o'clock on the West Coast. So we're sitting there in sort of a foyer, hallway type of area right before the show starts, and this person walked by. And I'll spare the vernacular, but I said, "I love you, you're smart as shit." And Lauren looked at me terrified. Now, that is true. What did I say that's not true?
I can confirm that it was in a very strange hallway.
Had he seen you speak at that point,
No.
or are you just making it up?
No, he just...
So his sense of smart. You have a good sense of smart.
No, I do.
Yeah.
But I've also seen her numerous times on CNBC.
Oh, okay.
And as I've said about a few people, CNBC, which I love, I've been part of now for over 18 years. A lot of people watch it without the sound on. They watch it as sort of background. God forbid something happens, it has to be on. But there are people that appear on the network that when you see him or her, you turn up the volume because you want to hear what he or she has to say.
Pump up the volume.
Lauren Goodwin is one of those people.
Oh.
Now, historically, you've been on sort of the afternoon closing bell or those types of shows. We're going to try to get her on CNBC's Fast Money, but we're fortunate to have you here today on the tape. Long-winded way of saying, welcome.
Thanks for having me.
Danny, she is brilliant, and she's put out some notes, and it all sort of lines up with some of the things that we're thinking about. But before we sort of get into it, talk about your background, because you're not necessarily a market prognosticator, but you clearly have a handle on all things that are going on in terms of the economy and those types of things.
Yeah, absolutely. Well, in my heart, I'm a jazz musician. And
Okay,
like to
stop.
Go to...
What
in your heart you're a musician, or for real?
No, in my heart.
Are you playing it? What instrument? God waves his magic wand, and he bestows upon you the ability to do something. What is it?
Well, I can play the piano.
Okay.
But if I were going to learn something new and God was going to wave his wand,
Right.
I'd totally pick up the drums. Just think of how many friends
Drums.
I'd make in my neighborhood.
Yeah.
Interesting. That's pretty good.
Well, Tim Seymour, I think you know who Tim is. Tim is on CNBC's Fast Money. He is a drummer. One of the great drummers of all time was Karen.
Look what you've done.
Was Karen Carpenter. People don't realize that.
Yeah.
She had great pipes, one of the top 5 voices of all
100%,
time.
yeah.
She also was an incredible drummer. Anyway, please continue, Lauren.
I'm an economist by training.
Thank you.
And come from really let's make economic forecasts sort of pins and needles type of economics. But over time, I've applied that to more and more of a financial markets context, looking at geopolitical risk, emerging markets. And now I sit at New York Life Investments, $725 billion in assets under management, public, private, you name it. And so speaking of sort of a playing field, it's everything under the sun. And so we've got to think in a really structured way about how we do not just investments, but also thinking about the long term, having more of a long term perspective.
Well, you're being modest because you want to play jazz and play drums and all that, but you ran track at University of Southern California, which is no joke. And we were talking about it. You ran the 400, which I think is the guts of all the races that there are. That's the one, right? So mentally, I find that the athletes, we use that term sometimes loosely, but truly the athletes that kind of get it. My partner, I bring him up, Porter Collins at my hedge fund for years, was a rower, Olympic rower. And you get that mentality, same thing. And you actually remind me of his wife, Lauren, who was from Texas also. I know you're from the great city of Grapevine, Texas. But long-winded way of saying, I'm looking at your resume, and you've accomplished a lot already, and I'm assuming in a young career, unless you look way younger, than you are. Really. So JP Morgan, Wells Fargo, and you had the opportunity to work at the OECD, which is really interesting to be in this time frame. So bring us forward right now, what those experiences meant, how it's led you to where you are right now at New York Life, what your role is truly there day to day. And after having read your stuff, and we're going to get into it, how did you become so smart here and all this stuff? So,
well, God waved a wand and just told me what to say to make you think I'm smart. Look, at where I am right now, New York Life Investments, we're a multi-boutique format. So lots of experts in their fields doing, private equity, private credit, bonds, whatever the case may be. My role is to look across that platform and say, what do we think about the world? Where might we have areas of disagreement, agreement? How can we come up with a cohesive investment strategy across, a lot of really deep and niche perspectives? And how does that apply to different client contexts? So in that sense, your traditional market strategist, what I think is so fun about the role and where sort of the me comes into it is that this is actually New York Life Investments, my first time in an asset allocation sort of expertise. I have a lot of time in the markets, a lot of time in economics, but first time in allocation. I'm working with some of the most interesting, smartest people out there. And so I have the opportunity to really go head to head with folks that just know a lot more about a lot of stuff than I do, and to pressure test thinking and add value where the economy is concerned. Because when you're looking at some of these asset classes, if you're a bond manager, you love talking about the Fed. If you're a private equity manager, maybe not, right? And so you have to I have to be able to be nimble and think in a lot of different contexts.
Let's talk about the economy, because again, we don't talk politics here, and this is not political, but the divergence between, I think, the stock market and the economy has probably never been wider, broader, more stark. And through the lens of, if the economy and the stock market were the same, President Biden's approval rating when it came to the market would be at all-time highs. And it's not. It's actually at all-time lows. So what is going on in your sense with the United States economy right now, broad brush?
So we've spent the last couple of months thinking a lot about this, because when I look at, the next 2 months, 12 months, 24 months, I say it's really difficult to see a specific reason why the economy slows enough into recession, but it's also difficult to see the reason why it accelerates, right? And when we really get down to why is that, it's because even though the labor market's strong, even though profit margins have been remarkably resilient, consumer confidence is not. Consumer spending's been fine, but you don't see a lot of enthusiasm. And there is one thing that explains that, and it's price levels. That's it. And we've all been talking about this for months, quarters, but we have a really interesting, almost forward example in Europe, where they're a little further ahead in their rate cutting cycle. They had a less pronounced boom and sort of slowdown than we've had in the US, but basically the same outline. They're a little bit ahead of us. Consumer incomes are fine. Disposable income, relatively healthy on an aggregate level. Nobody is picking up spending. And so when I look at the year ahead, I think, why would it be any different here? What's the catalyst to make people feel more confident when we just had 2 knockout years of risk asset gains?
So you mentioned that from an earnings valuation perspective, that the market's pricing in 10% growth for 24 in earnings and 15 in 25. I'm not going to ask you whether you believe that can happen, because I know there are certain large companies that make up a component of the S&P which are bringing in a lot of efficiencies and can grow. My question for you is that if that were actually to occur, it's hard to see inflation still coming down in that environment with that type of growth. So how do you kind of jive that all together in terms of what your thought process would be for the Fed if you actually were able to achieve 15% earnings growth in 2025?
Well, what's clear for the Fed is that the market's a little over its skis on expectations of rate cuts. Now, that doesn't have to necessarily be a horrible situation. You could see sort of the 10-year inch back up a little bit over the next couple of quarters. Like, it doesn't have to be a nail in a coffin in terms of risk asset performance. What makes me, if I were to be concerned about that difference, the expectation that, look, like growth is actually okay. And though we might see a little bit of unsteadiness here in the next couple of months over a 6-month basis, maybe the Fed can't cut as quickly as the market expects. What really worries me is there anything else that happens that makes that correction in duration happen a lot quicker? Is the economy exposed to an interest rate risk just based on this expectation that the Fed's going to cut another 150 or so basis points that ends up unwinding? I think the very clear-cut time-bound risk there is, do we get a sweep in either direction of the election here in a month? If we don't, then the sort of balance beam or tightrope, or pick your metaphor, that the Fed is walking with respect to growth that is good, above trend, could potentially be inflationary if we do see a reacceleration versus not. Like, that's just a tightrope that we're all going to have to continue walking.
Well, let's talk about, one in your notes, beware a U.S. sweep in the election, beware a sweep in the U.S. election in terms of what it potentially could mean. Obviously, a divided government, things don't get done, but a sweep in either way suggests maybe the inflation genie, which everybody seems to think is back in the bottle, might not be. So thoughts on the ramifications if, in fact, one party swept?
So I'm going to give you an easy one and then a real sort of like deep cut one. So
Like that.
I think the obvious takeaway of a sweep in either direction is that you have an increase in government spending from here. Either party would spend on very different things, but you're looking at an environment where the knee-jerk reaction from the market is, okay, sweep, that's higher spending, growth, inflation rates. And that's why I think you could see a reset in the interest rate risk or duration assumption that investors have on November 6th, if that were the case. But let me go into the deep, dark doom hole that economists love to sit in. When I think about the U.S. government debt and deficit, I would say it's actually one of two questions I've gotten consistently in my entire career. When does U.S. government spending start to be a problem? And when does the dollar stop being interesting to world investors? And I want to put a caveat here and say, I am not saying that this is going to happen in the next 4 years. But the path, we've done a lot of really, I think, cool research on how the dollar actually gets replaced. And there's only really been 3 or 4 currency transitions in all of economic history. And that's because when a currency is replaced, it's not because, in today's terms, China becomes more important or Europe becomes more important and overtakes the dollar in terms of transaction volume. It's because a more efficient system takes over. So the dollar is today's reserve currency because the U.S. dollar, amid the invention of commercial aviation and the telegraph and all these technologies, became essentially a fiat currency system globally that was a lot more efficient than shipping silver around the world with the pound sterling. So if I then sort of rewind back a bit, there's no alternative to using the dollar today. But if U.S. debt and our maturity, frankly, in handling it, and our use of this global financial system as a geopolitical mechanism becomes more and more costly for everyone else in the world, then the incentive to develop that more efficient system is higher, right? And so I think the real risk of a sweep is that folks start to get more concerned about the fact that the interest payments on our debt is more than our defense budget. But then if I fast forward that 15, 20, 30 years, we might look back at some of these events of the last couple years and the next couple and say that was the beginning of making it really hard to trust the U.S.
Now, people listening will say what Lauren just described is the reason why Bitcoin was created. Efficiencies, the concern about fiat currency, and those types of things. But, we'll sort of shelve that for a second. But if you go back, and you're a historian clearly, no developed economy in history has been able to sort of recover from about 130% debt to GDP levels, which we are fast approaching. So I agree with everything you just said, specifically about the efficiencies of the entire thing. But that seemingly is the point where things start to matter. Does it not? Is it different this time? And I hate that expression, but for lack of a better one.
Yes and no. So the no is, I think that U.S. debt and deficit's going to start to matter more politically, internal to the U.S., in this next presidential cycle, because what we've seen also historically is that turning point for we might need to actually balance the budget is very closely tied to this dynamic between our interest coverage cost right now and major budget line items like defense, like education. And so when you're spending more on interest than you are on defense, people start to be concerned about that, start to ask questions. And so U.S. politicians may, I think, in this next presidential cycle, have to pay a lot more attention to it. So that I don't think is particularly different.
It's very nice that you're the first guest to come on where Guy and I or Dan didn't have to preempt the debt question. You actually brought it up. So it wasn't us that did it this time. That's good.
Thank you.
So in your macro pulse that you put out on Monday, I know it says New York Life, but I think it's you that actually writes that one. You mentioned something that's near and dear to Guy's heart, which dovetails completely with what you're talking about, dollar debasement and all these other things occurring, which is gold. And then we can move into uranium, natural gas kind of commodities. You've made a correct, I believe, and a prescient call of what's going to happen here about people are underweight commodities in general. But maybe start with gold specifically, and then let's walk through kind of the underlying drivers for uranium and natural gas here.
I love gold right now. Not, as an investment, sure, but just as a topic, wow, so interesting. Because, people think of gold as a sort of a safety net asset class, an inflation hedge, any number of things. The last 15 years, gold's been in sort of a new regime where it's not so much about actually any inflation risk, but rather the central banks printing money. And I would argue that central banks printing money, at least on its own, didn't have anything much to do with inflation. And so gold is this really interesting, very macro asset class. We have seen, actually, I mentioned top questions in my career. I'll add geopolitical risk, like does it matter? We are in the 2020s seeing a structural increase in the incidence of geopolitical risk. Full stop. And so even on that point alone, if you were just expecting more event risk, not big paradigm shifts in the way the market works and not whatever, just more event risk, you would want more oil, gold, and if you can stomach it, Bitcoin. And so from my perspective, looking out at the next year, this is an asset class where if you just were not even capital C concerned about any U.S. debt issue or any inflation issue or any global growth issue, but just saying, I'm not really sure, you would be a buyer of gold.
All right. So what I've said, I believe this to be the case. I think central banks have been hedging their own ineptitude. If you look over the last 3 years, buying gold in record amounts. I think 3 years ago, I think they bought, I want to say 1,121 tons worth $71 billion. That was a record. And we've been pretty consistent along the last few years, China leading the way. So that actually makes sense to me. I am in the bull camp. Danny is as well. I've been there for quite some time. Is there a bear case right now? And if there is a bear case for gold, what do you think it is? Fiscal response, like all of a sudden we become fiscally responsible overnight. Like what is the bear case?
The bear case, something has to happen before the bear case. So in my view, you have to have a bull case before you have a bear case.
Agreed.
Because I love what you're saying about central bank buying. Totally agree. If you're not going to fight the Fed, don't fight the Fed and also every other central bank in the world. I think in order to have a bear case for gold, you have to have a deeply disinflationary 10-year expectation. And there are lots of ways we could get there, but none of them happen before a drawdown in U.S. growth, in which case you would be a buyer of gold.
It feels like on the margin, dollar strength right now on a day like today, gold kind of sells off a little bit, but every dip has been a buying opportunity. I want to shift to uranium because it's now become not just a commodity, but it's a useful commodity now with nuclear being talked about and AI. It's amazing how you went from AI is creating the growth in utilities is really something. So talk about uranium because I know you've written on that before. It's a topic we talk about.
Yeah, so it's interesting actually to me that the AI trade has broadened to this place as quickly as it has. And I think it makes a lot of sense, but I'm sort of interested and excited to see it. AI is power hungry. And so you need data centers and they need energy to work and to cool. You also need energy to build all the stuff that makes them possible, et cetera. So the stat that, it shocks me even knowing it, is that by 2030, so that's tomorrow. By 2030, we need to globally create the power generation of Germany just to cover the AI demand we see today. So forget if that accelerates because it becomes more productive and more companies use it, whatever the case may be. So in that case, you need energy and a lot of it. And one of the reasons I think we've seen quality brown energy, low-cost green energy, like really any sort of energy start to perform on more of a structural broadening basis is because of this energy demand. And so if you're thinking about the long term in any capacity, there's a big debate about whether nuclear is green enough, whether we being the global economy should be investing in it vis-a-vis other, solar or wind options. The reality is that any spigot you have to turn on makes a lot of sense right now. And so uranium, nuclear, brown, green, like if it's energy, I think it's a really interesting 5-year play, maybe even longer. And I think one of the reasons why we're talking about it now is not just that the market's sort of waking up to this energy demand, but also because rates are moving lower. And rates moving lower are good for utilities, they're good for energy. And so we're starting to see a cyclical uplift of what is obviously a structural story.
It's interesting, a day like today where OpenAI raises $6 billion in equity at 100-something billion valuation. They're going to burn $5 billion in cash this year, but they are growing their revenues and so forth. And they're using that money to buy NVIDIA chips, which is being brought on by the demand from Microsoft signs a nuclear deal, Amazon signs a nuclear deal, Google's talking today more about deals in the future, nuclear deals. And there's no question whether you think these companies can all make money from it, meaning the enterprise companies, meaning how cyclical is this going to be. The demand on energy is true. And these CEOs of these major enterprises are telling you the generative AI demand is, like in terms of power demand, is massive. So that part's here to stay. And so it is amazing to me what it's going to look like. But natural gas, we've seen a run in the last kind of month or so. And yes, there's seasonality to it. Guy and I have talked about it obviously before. As a replacement, it's kind of a clean energy. It seems like it's now having its day. Do you have any thoughts on natural gas here?
Yeah, it's the same story. It has to do with, how do we diversify, again, we, the global economy, diversify our energy mix. And if you look at what that might mean, not to sort of swoop back into the geopolitical, but just to try and tell a slightly different angle of what I think is the same story. You have a country like the U.S., which does have, is endowed with a lot of natural resource. You have places like Europe that have been much more gung-ho for much longer in investing in green energy because they are not endowed with that resource. Same story for Japan. And I think what we're liable to see as AI becomes more and more important is not just investment in these minerals and materials that make the energy production possible, not just the energy itself, but also in the sort of networked capability to share this energy. We talk a lot about friendshoring. It took an invasion to start really seriously talking about LNG terminals between the U.S. and Europe. When you just think about the materials demand, the investment, the sort of the capital investment impulse, and then, when you loop it back to the U.S. economy, the inflation impulse, it's hard for me to see the concrete end. And what I think is important is because, there are lots of technologies that have been really interesting. I think electric vehicles are a really good example of something that makes a lot of sense for people, but hasn't seen the consistency and global nature of demand that AI has. And I think that has to do with the government sees it as a strategic competitive priority. Companies see it as a real opportunity, and normal people know how to use it. Now, it doesn't have the same value to all three of those groups right now, but over time, it's very clear to me that capital-intensive nature of the technology is going to persist.
All right, we're 25 minutes in. We haven't mentioned China yet, but that dovetails nicely with everything we've just talked about for the last few minutes in terms of commodities and resources and those things. I submit, and I'm not saying I'm right, but as much as China will say it's about sort of shoring up our economy, to me, what we've seen over the last week is all about their markets, and we'll see how long that lasts. But I do think by definition, it's going to create a huge tailwind for some of these resource trades that have been floundering recently. Is that an accurate assessment by me, do you think?
I do. I have learned with China to never assume you know exactly what they're doing. Like just sit and watch and let it play out. I think the pandemic is a really good example. They were sort of first in, first out of that of the lockdowns. I really struggle to find the word lockdowns. That was a lot more about being able to track people than it was about health. We could say similar things in different ways for different countries. I don't mean to pick on China, but I always sort of sit and think about, if I were the Chinese government, what do I need for social stability? And in China, because for a very long time, China was a government investment-driven economy, production-driven economy, the engine of sort of social stability and consumer spending, not dissimilar from the US actually, is in people's homes and it's in their investments. And so shoring up the Chinese market is about keeping the consumer afloat, keeping confidence reasonable, and that's what keeps the floor under the Chinese economy. They'll worry about what the rest of the world thinks later or maybe never. It is all about keeping the Chinese consumer going and the political party stable.
Oil has been such an important component of the U.S. consumer, which I'll get to in a second, and it's hard to determine when oil was drifting from the kind of mid-'80s to the high '60s. Was it China? Was it people saying there's no growth in China? And it feels like the geopolitics in the Middle East were being completely ignored. A couple days of unrest in the Middle East. Now we've seen what oil can do. It's hard to tell. I'm sure there's a little piece of China in there as well. But as it relates to the U.S. consumer, and we talked about it actually on last week's podcast, was that with Dan Greenhouse, was that it's been kind of a tailwind for the consumer, an unspoken tailwind. And now oil is moving back up the other way. So I'm wondering how important oil is to your thesis on the U.S. consumer, to inflation, and just on the margin. It's a tax, right? So where does oil, if it goes to a certain level, when you start to be concerned about the impact?
Only Dan's and a guy, always talking
You like
about
that.
what matters.
Yeah.
I loved it.
And a Lauren.
And now a
And now a
Lauren.
Lauren.
The price of gas is so important to the U.S. consumer. We were talking a bit offline before the show started about how the real challenge for the U.S. consumer right now is just price levels. So you see price growth in one of the assets that is the most important to people's day-to-day expense. It obviously matters. I think the good news for the U.S. consumer is that the sort of structure of global supply and demand for oil has changed so much in the last 15 years. The invention or discovery of fracking has completely changed the way energy sort of flows globally. It's made the U.S. not just a more important producer, but a swing producer. And though I think with our strategic petroleum reserves being spent down and other factors, there is still very much a risk of potential price shock in energy markets. The ability for such a price shock to be really long-lasting and painful without any opportunity for improvement is lower than it used to be. Now, I think that changes over time with the energy demand for AI and business needs that we've been talking about. And I think the major, there is a wild card for me, which is Iran and how production there has been higher with less sanctions from the U.S. or less enforcement of sanctions from the U.S. But my sense that we would have a prolonged, couple months real shock in energy prices is less dangerous than it would have been 5-10 years ago.
There's so much going on right now in the world. It's hard to pinpoint something, but when you throw in the oil increase and now with this International Longshoremen's Association strike, my point is that imagine on your bingo card as an investor what you have to start thinking about all these things. Have you thought about it?
Yeah, I think that this is the real life manifestation of what really the investors have been talking about, which is that when you have climate change, a supply chain network globally that is less about efficiency and more about access to resources, so it's more disjointed, more expensive. You have a geopolitical environment that's changing. There's more incidents of geopolitical risk now, but that has a lot to do with sort of great power dynamics shifting the technology supply chain. Oh, and by the way, we're all spending a lot of money on the technology supply chain. That is a global environment that is necessarily less efficient than what we've gotten used to. And so I think it is impossible to discount the risk that inflation, and I'm talking about now, but really I'm talking about, for the foreseeable future, the risk that inflation refirms. It's just really difficult to see a world where, 1.5 5% inflation is your 5-year norm, because the capital intensivity, the infrastructure cost, the disruptability of the global economy, it's just a little more pernicious. Now, that sounds so scary, and I kind of hate doing that, but I think what that ends up looking like in the real markets is your range, your reasonable range on your 10-year just has to be wider. And so, especially now with the 10-year sitting where it is, when folks say, I'm looking to add duration, my first question is, are you sure? Because you have to expect that expectations around inflation and rates risk are going to be more volatile.
It's an interesting point. So, when you say that, also the protectionist policies of a number of different countries around the world, I think by definition are inflationary. And I like what you said about duration. Stan Druckenmiller was just at a conference, and I think almost 20% of his portfolio is now short bonds, which suggests he thinks that interest rates are going higher for a myriad of different reasons. So my question to you is this, and we spent a lot of time on this over the last few years, but I think it was March or April when we broke the record for the longest duration of an inverted yield curve. I think we broke it from the 1978 to 80 period of time. We are now steep into the tune of about 14 basis points or so, which is a big deal. Yeah. But again, historically, it's not the inversion that you should be concerned about. That's the warning sign. It's the re-steepening that suggests something is on the horizon. Am I being too hyperbolic, or is there something that should be concerning about this?
No, you're not being too hyperbolic. That's exactly what history tells us. And I list, and actually both of you have, list a bunch of reasons why, with markets rich as they are, there's just risk to valuations. And I think actually that risk to valuations is a real risk to the economy, because the people that are spending in the U.S. economy are high income folks that have benefited from this wealth effect, that have benefited from 3% mortgages with house prices rising, that have benefited from this environment. And so if you saw a quarter of just consistent sort of S&P sludginess to the downside, that's a draw that causes a drawback in spending. So that can actually hurt the real economy. But I expect, absent some of the fun stuff that like port strikes and et cetera, I expect, growth is still above trend. So we still have a ways to slow before we're really in trouble. I expect that we have let's say 6-9 months ahead of average risk asset returns, let's say 5% on the S&P 500, spreads go about nowhere. And that is fine. It's just that after 2 years of knockout risk asset returns, it's going to feel crappy. And so investors really have to think about, okay, how do I manage reinvestment risk? Even if the Fed moves another 50, 75 basis points lower, that's a lot of return I'm not getting out of cash. How do I diversify equity to sort of acknowledge that valuations, though not a timing tool, are high? And one of the things when it comes to sort of duration specifically is that I like short duration, not only because I'm worried about interest rate risk, but also because if I look at the maturity wall and I can get, 7 to 9%, depending on the asset class or the benchmark, in sort of nominal carry on a 2 to 3 year duration bond fund with no maturity wall risk, just hold that to par. That's not bad. When you look at all the different options and different scenarios that the economy could have, that 2 to 3 year duration sort of time horizon actually just makes sort of economic sense to me.
I'll do something positive here, which is just on the movement we've had in rates in the last few weeks. You've seen a little bit of a refi wave in home equity. And I realize, again, economy's bifurcated, so not everybody gets the benefit of it, but there was a lot of built up value in people's homes, and you're just in the beginning potential of what that could unlock. And so there is a source of a lot of liquidity and potential consumer strength sitting there. So I'm not going to try to predict where rates go. I want to get your opinion on that. And secondly, as it relates to the Federal Reserve, it's interesting to me that on their portfolio of mortgage-backed securities, which is still north of $2 trillion, when they slowed down this quantitative tightening, they did it in treasuries. They're still letting $35 billion a month roll off in mortgage-backed securities. And I'm thinking to myself, down the line next year, if mortgage-backed securities are still, haven't increased in price or spreads haven't come down like they could, that's probably a lever that the Fed potentially pulls. So give me your thoughts on kind of home equity, home prices, and maybe the Fed's role potentially in that?
Oh, I'm going to be so unsatisfying on this question because I think housing in this cycle is really hard because unlike in the financial crisis, most people, 80% of mortgage holders have a fixed rate mortgage. And so a lot of people have not been impacted by higher mortgage rates. That doesn't mean that people haven't been. It just means that a lot of people haven't
And
been.
it's below 5% on average, too, the rate of that. Yeah.
Exactly.
Yeah.
And so, you're not going to refi at 5 or even 4.5%. It is already beginning to stir up activity, and that is a positive, full stop. But when it comes to just how much of a boon will this be to the economy, the other sort of factor in this cycle, of course, is that a lot of people moved because of the pandemic. And house prices really everywhere are high. So affordability is poor. And I don't know how you fix that. You might see a bit of sort of forced activity in it. I mean, in addition to the excited activity because, mortgage rates have come down and I'm ready to move into a bigger place or whatever the case may be, or I can finally afford a home. You'll see that. You may see activity because we see more and more folks needing to go to the office 4 or 5 days a week, which just, it's harder than to do a 90-minute commute both ways if that's what you've been doing for 2 or 3 days a week. But really, I'm asking myself the question, the 30-year mortgage, that's a financial security that the introduction of it in the U.S. economy made a ton of sense. This is, in a mostly pension-free society, this is how a lot of people build their wealth. No one should lend me money for 30 years at 3% or even 5%. That doesn't make any sense. And so we have an environment where home prices are very high as a result. And so I expect that interest rate moving lower and mortgage rates moving lower will have a benefit to the housing market in the U.S. economy. But I don't think we easily get rid of the affordability crisis that we're seeing now in many more cities because of the pandemic movement.
Claudia Sahm is probably uneasy that her name has been invoked as often as it has over the last couple of months.
Wouldn't you be?
I'd actually sort of dig it. If I had an Adami rule and
Right,
it
Adami
actually
rule.
was triggered,
Right.
What would the Adami rule be about?
badassery.
Oh, okay.
Like the
There'd be
level,
so many rules.
scale.
the level of
It would-
badassery one can
If you
achieve.
he'd come in with one rule a day. You know what? I just thought of another rule. It
Uh-oh.
could
No,
be-
I'm
it could
too-
encompass
I'm
anything.
way too scattered.
Yeah.
It's a pain threshold thing, actually, if you really want to know. Like, I pride myself on being able to sort of endure the most amount of pain that anybody I know. And I could list a number of different things, but that's neither here nor there. But such a huge component of this is the employment picture. Now, the optimist will say, yes, we've come off 3.4%. We moved higher, but we're still historically very low. The pessimist will say, regardless, we have triggered the Sahm rule, which historically since 1970 has triggered a recession each time. Where do you come in this whole thing? Because I think, and I've said this, I'm not suggesting I'm right, but it's sort of exit velocity with the unemployment rate. Once it starts to move, it doesn't stop necessarily. So the same way the Fed thought they could control inflation, they weren't able to, is almost the same way I think they can be able to control the unemployment rate, which I think is going to go a lot higher than people think. Thoughts?
I agree the unemployment rate's very likely to move higher. I might be between your two scenarios. I might, and this is, going to be the one time in my life I get to say this. I might be Goldilocks just
You hate saying that, don't
right.
you?
I hate it.
You hate it, don't you?
Well, who doesn't hate it after the last couple of years?
Right.
I see a labor market that has cooled, and I believe will continue to cool. Profit margins are still pretty good. And so it's difficult to see the source of mass layoffs. Now, again, I could make the list, but it's difficult to see the source of mass layoffs. So I do think that the unemployment rate will continue to tick higher. Where I worry for the consumer, and it's a lowercase w worry, I worry for the consumer that I also don't really see the enormous source of rehiring. Labor, has been gobbled up over the past couple of years. It's expensive. Wage growth is still well over 3.5%. It's still a pretty tight labor market. And so the source of yes, I need 5 more people is unlikely to be forthcoming. But the source of mass layoffs, I don't see either. And yes, it will vary by industry. Construction, especially for manufacturing, has been great. Retail has been good. You've had segments of the economy that are still creating jobs, and then others like our industry that really aren't. So I do expect that layoffs or sort of job loss will pick up, the unemployment rate will pick up, but I struggle to see the near-term deep, dark problem.
So as people are listening to this tomorrow, we'll have seen the September jobs report.
Yeah,
and I agree with you that if there's an uptick in unemployment, it'll be Fed's going 50 in November. If there's downtick, Fed's still going to go at least 25. The economy is strong. I get it. We're kind of in that grip here. But let's go into your kind of asset allocation model and what you're suggesting to your clients right now where they should be putting their money. We've touched on a couple of industries and stuff, but give us your thoughts here on what you're telling your clients.
So this is as much like potential downside and worries and risks and things and moderate market outcomes that we expect. It's actually a pretty constructive scenario, right? Average equity and bond market returns is not bad. So I think we have to focus on what we know. And there are a couple of things that we really, really know. We know the Fed is cutting, and actually globally, central banks are cutting outside of Japan. That is an environment where reinvestment risk has become everyone's worst enemy. And though we're seeing, I think, and frankly, I don't expect people to do a whole heck of a lot before the election. We're seeing an uptick in money markets just out of uncertainty. This is an environment where moving from cash into short duration fixed income, I think, makes a ton of sense. For people that need to balance duration, the municipal bond curve has been uninverted, and long-term municipal bonds are infrastructure. So that's kind of an interesting way to balance duration for those that try to maintain some sort of intermediate option. I also really like structured credit, just given the opportunity to lock in higher interest rates. And we're seeing credit quality really quite healthy across even high yield. Like the high quality segment of high yield, I think, is a really interesting opportunity. In equity, it's all about just diversifying your concentration risk. I have no problem with valuations where they are per se, but you just acknowledge that you get more and more vulnerable the more steps up. So we've talked about energy. I really like energy. I like utilities. Both of those more of the infrastructure AI with some cyclical backdrop as rates move lower. And REITs tend to do well when interest rates move lower as well. So we've started to add that real asset component.
Yeah, some of these REITs have had a huge move over the last, historic in some way. Understanding that a lot of them sold off in a meaningful way. But embedded in that great answer was you brought up Japan and what they're doing as a central bank. So, 1989, I think the Nikkei made an all-time high, and then it spent the next 20 years basically going lower. Recently, we basically traded right back up to that prior all-time high. Now, over the course of the last couple months, we see typically 2% days up and down. We saw a nearly 5% down day earlier this week in the Nikkei. We obviously have currency volatility like we haven't seen in a very long time in terms of dollar yen. A lot of moving parts for the fourth largest economy still in the world. The importance of that, if any,
is pretty important. First thing that's important, the last couple of years, negative interest rate policy globally is over. So I mentioned, a bit more of a range on the 10-year, the U.S. 10-year. That's, there's more flame to that fire. How you put gas on the fire? I don't know.
Yeah.
There's a metaphor there. There's more going on there because there's a big difference between paying a tax on your own government's bond yield versus having like a 0 or 0.1% yield. It makes a difference globally. I, though, expect that the Bank of Japan is just as concerned about this currency volatility as the rest of us are. If the U.S. sort of soft landing narrative continues and markets are well behaved, financial conditions have been loose and are only loosening. That's an environment where, because of the inflation that they're seeing there, they could make modest moves in December. If there's any sort of market hiccup, whether it's election related or something else, they're not doing anything for months and months. And so Japan matters a lot, but I think they're aware of what that currency volatility has meant, what it means for their own economy. Import price inflation is the reason for this season. That's why they're making this adjustment. And they have every incentive to be careful about it.
Well, you mentioned earlier that the next regime here in the U.S., it's important to tackle fiscal deficit and all those problems. Well, it's not a coincidence that there's a new prime minister in Japan, there's a new prime minister in the U.K., and in the last 24 hours, the stuff coming out of each of those has been, quote, more dovish than had been expected. And that's, you've seen them move like that. And we've talked before about, investors don't have to care about it, but they need to be aware of it, that those type of moves and the yen weakening all of a sudden if it goes back to 150, 155, let's keep in mind oil prices are now going up. And you have to start to think about those things. Maybe not today, but there has to be in the background. And I think the markets and everyone has been about immediate gratification, and I'm just trading what it is today. But I think the backdrop of this, which is what I've read your stuff, which is what you do really well, is just put that in your mind and think about it, because it could really matter in the future. So that, I think, is the real question: is why do I care? When should I care? And what should I care about? Right?
It's really, really, really smart what you just said about if the yen is weakening, and that would mean the dollar strengthening, like they are importing oil and really everything else. And that is where this inflation sources come from. The dollar is so important for global finance. And one thing that we talk a lot about is, you in a sort of Goldilocks moment, you might see some dollar weakness. But really, really, like a dollar weakening regime requires the rest of the world to be performing better economically than the U.S. is. This has actually been one of the periods of a couple of quarters, they don't actually happen very often, where the U.S. is categorically economically outperforming the rest of the world. And so that's not an environment where I can see the dollar consistently or meaningfully weakening. Especially, look, if we're wrong and the U.S. economy slows a lot faster than I think it does, then that's also a bid on the dollar. And so I think we're going to see the dollar, just like I guess everything else, being a bit range bound in this environment.
We've talked for about 50 minutes, a wide range of things. Have we not brought something up that's been on your radar screen that you've been sort of thinking about that, we should all be focused on, if anything?
The only thing we haven't talked a ton about yet is the private markets. And here I think the, let's say, normalizing or really flattening of the yield curve, that importance just really cannot be overstated. It is so, 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 so important. You've seen globally a rate hiking cycle mean that just deal flow doesn't go anywhere. And the flattening yield curve is historically incredibly constructive for private credit growth. Now, in order for private credit growth or bank lending growth to balloon, you need to have lenders that are excited about their borrowers. They're excited about the economy. Like the yield curve itself doesn't do it. But because the credit backdrop in the private markets is reasonably healthy, we are starting to see churn in the markets where lower quality borrowers are starting to churn out, but deal flow is starting to get done. And that's a situation where investors might be saying, okay, valuation is bottoming. And so while in the public markets, we've had valuations move higher, 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 in a sense, the opposite thing is happening in the private markets where, you don't have to sell anything, so valuation goes nowhere. Now deal flow is moving, and we're starting to see more activity on that side of our book. And so I urge investors to keep like one blinder open, because it is at the end of the day real economic activity and contributes to some of the buoyancy we're seeing.
How do you feel about retail investors getting the glory and access to all of a sudden private credit? We know I can be very cynical about it in general. How are the retail investors going to discern between what's being shown to them and whether to invest in this private credit? Because the markets are saying they're going to grow from 1.7 trillion to 3 to 4 trillion, and it's a whole new avenue that is yet to be explored there. So
you've just asked exactly the right question, which is how do you discern?
Hold on a second. In the course of the last 7 minutes, you've complimented him in ways that I've never seen before twice. Yep. So Danny Moses,
I feel I'm basking
in the glory.
Yes,
please continue, Lauren.
How do you discern? Because look, when it comes to access, I'm very pro access. It's so hard to build wealth in an opportunity set that you only get after like 17 different rounds of value creation.
Bites at the apple.
Yeah, like by the time a company goes public, there have been so many rounds of value creation, and so public market investors are missing out. And for most investors, you do not need your portfolio to be 100% liquid 100% of the time. For some, it's true, but for most, it's not. So I like the idea. And I think that there are ways where if you acknowledge the illiquidity of the asset class, that it can be constructive. But that discernment part is really important, because the idea that you can mark to market a truly private portfolio on a daily basis today, the way that investment products work, is not true. So an evergreen fund or an opportunity that really is acknowledging the illiquidity on top of course, manager selection and all these other things that are important about choosing investments, no matter what type of asset class you're in. Like, I can get on board with that. But mark-to-market daily strategies on an illiquid portfolio, that is, I have not heard the story yet that makes me comfortable.
Well, we've already seen it in fixed income in general. We had this bank loan issue years ago where there's ETFs that were lined up to be, on the books for the assets are supposed to be 20-year in duration, and people are trading them by the second, and it caused issues. So, we'll see how that panned out. I wanted to mention one particular single name, if I could, that I think encompasses a lot of what we talked about here. And I'm not expecting you to know, but you probably will know a lot about what's going on there, which is Boeing. They're dealing with the labor strike, right? They're dealing with a lot of issues that are kind of out there. And I find it really interesting to me in terms of educating the investor. The Boeing is junk. The debt, the balance sheet is junk in every category, except that Moody's, Fitch, and S&P won't downgrade it because the government's probably saying, do us a favor, just don't do that yet because it does trigger higher payments, right? The bonds trade better than, they probably played AA maybe at this point. And now they're out there saying they're going to raise $10 billion in equity like they did earlier in the week, which is, you never do that into the market unless you actually have the deal done, so the stock's drifting. I guess what I'm saying is, when you get an asset like a Boeing and you're trying to tell your investors, not that you give single names perspective, how to invest in something like that when the bonds aren't trading where they should on the metrics of the company because the government will end up probably doing something for them. I don't know if you want to comment on a journal. It's a story I'm tracking for many reasons, but just curious to get your thoughts on Boeing.
It does start to feel a little bit like too big to fail, right? And so if I had anything to say about it, it would be that, the idea that a single national airline champion, which has increasingly been run by MBA types as opposed to engineers. That's one of the things that we hear the most about, sort of some of the challenges we've seen there. In an economy that prides itself on ingenuity and free market capitalism, it feels like a mismatch, right? And so I think that the reason that you can see an equity price float the way it has is because of that implicit government guarantee.
That's right.
And so the question then becomes like, is that permanent? And if the answer is yes, or if the answer was no, we'd expect the Fed to then be cutting faster into a financial stability risk, then maybe you don't care. But on a case by case basis, I agree with your concern.
They have 40% of the business comes from the government, so it's already implied. And during COVID, if you remember, in 2020, they were going to borrow money from the government, but they took to your point, the implied guarantee and just issued $25 billion more in debt to do it. So I have a theory that if the government were to do something for Boeing, it benefits everybody. Benefits the taxpayer, because you're not charging us X amount for this defense stuff, you're going to charge a little less. Benefits the consumer, because the airlines, when you go say, hey, you want to lease planes from Boeing, we're giving you an artificially low rate. You're not going to gouge the consumer. I realize this will never happen, but the thought process would be, if you're going to help a company or do something, Boeing's a perfect example, and you have 170,000 employees and all this stuff. But anyway, I think this is going to be front and center play out, but it's a microcosm to me
100%.
of capital markets and strikes and everything that's going on.
And a company that's been now mismanaged probably for the last 5 or 6 years for a myriad of different reasons. We've had Lauren Goodwin with us for the last 55 minutes.
But who's counting?
I'm not counting, but I'm looking at the clock. By the way, you should check her out. Her podcast is Market Matters. Check that out. Lauren, thanks for joining us.
Thanks for having me.
Thanks, Lauren.